Hi guys, thanks for coming. I'd like to start off with my panel just introducing themselves, talking a little bit about your firm, what stage of investments you guys are, and yeah, give us an introduction. We'll start with you, Joe.
Hey everyone, Joe Bruzzesi, general partner at RW3 Ventures. We're a one-year-old VC fund based out of New York. We invest pre-seed through Series A. We've looked at about 500 deals in the last 12 months and have invested in 15.
Hey everybody, Bryan Myint. I'm the co-founder of Public Crypto. We do things that vary from providing advisory services to Web3 companies. We run infrastructure for all sorts of layer 1s and layer 2s, including Avalanche. And we also have a crypto fund. So if you're a builder in the space, then we likely have something for you guys.
Hello, my name is Sarah Gottwald. I'm the managing director of Blockchain Founders Group. We are mainly focusing on building startups, so we have an accelerator, and yeah, it's a program about 3 months. You can apply for that, and if you get accepted, we will kind of guide you through the beginning. So we start super early, so basically if there's not even an MVP, sometimes not even a company. So we help you with setting up everything at the beginning, and we also do some investments, also super early stage. So we have like 45 investments, or we made 45 investments, and 15 out of them are done by our own accelerator.
Great, thanks guys. Could you discuss a little bit about what areas you invest in? So I know you mentioned briefly, but maybe we could go into more detail, like infrastructure, trading mechanisms, what areas you guys invest in. Bryan, do you want to start?
Yeah. We primarily invest post-seed to Series A stage of companies. We focus mainly on the infrastructure side, and also we like companies that are building in an interoperable multi-chain type of world. So we believe in kind of, partially the fat protocol thesis. We do think layer 1s and layer 2s are still where a lot of building and value accrual is going to happen. We're looking more into wallet infrastructure, decentralized ID, security, cross-chain bridges, and things like that. Not so much in the application layer just yet, so hopefully we'll get there soon.
Joe?
So we invest in 4 core buckets: infrastructure, crypto native financial services, DeFi, and then I think the long tail for us is the consumer apps of Web3. Most of that last bucket has been in gaming. We've seen a tremendous amount of deal flow there, and we're really excited about that product market fit specifically.
Yeah, so for us, like I already said, super early, so pre-seed. And we mainly focus on bridging Web 2 to Web 3, so not the deep tech, not the infrastructure project, but everything else around. Yeah.
Great. So after a pretty difficult year, what advice do you guys have for both VCs and founders? What do they need to know about navigating the new venture landscape? How should founders be thinking about fundraising? Could we go into some detail about that? Bryan, do you want to start?
Yeah, I think that, so we work with founders a lot, not only on the investment side, but on the advisory side, where we kind of help founders with just strategizing generally how to build their business and raise capital. I think the biggest thing right now is, if possible, kind of stay as lean as possible and continue building, just because the investment appetite isn't as strong as it was prior. So if you're able to stay building and show your commitment during a winter like this, people will take notice. I think a lot of my strongest connections were made in the crypto winter of 2019, and the people that I knew that were building there, I knew they were very serious about it. I think the same thing is happening right now. And my recommendation really to builders now is just really focus on the product and focus on user acquisition, kind of refining your product market fit. And once you are, in a place where you feel like the product's ready, and of course your runway's at a point where you're like, okay, I should probably fundraise now, then go ahead and do it. My main recommendation is to not get greedy with raising capital right now and to not raise prematurely, because I think a lot of VCs, especially these days, are very, very picky with their due diligence and very stingy with valuations and who they choose to invest in. So as a founder, just really focus on the product right now and hopefully wait until the landscape gets better, or you have something that you're actually very proud to show off to investors.
Yeah, maybe to add some things. So I mean, the advice is super similar, focus on the product. But what we actually see is that normally if you want to raise funds, there is more than one VC needed. And at the moment, the VCs are super hesitant, so they kind of really wait. And even if there's one or two VCs that want to invest in you, it's often not enough. So you need to have 3 or sometimes 4 VCs who really believe in your product. So this is why it's super tough. And if you raise, you have to give up a lot of equity. So waiting if possible, but if you really need to be aware of your numbers. So what really needs to be done, which money need to be spent. So take care of that as well. And yeah, I think it's like at the moment, everything is kind of trending sideways. And yeah, basically, nothing to add.
I think there's 3 big things I would say to founders. The first is that you should set your entry valuation properly, and I'll talk about that more in a second. The second thing is that if I get away from a call with you and I can't sum up what you do in 3 to 5 sentences, I'm probably not going to remember you. Every VC I'm talking to in crypto is still seeing tremendous deal flow. And I think a lot of times what I see from founders is their decks are way too long. They want to be way too technical. And after you get off a call with someone, if I don't know in 3 to 5 bullet points what you do, what your value is, what your raise is, it's going to be really hard for me to remember you. And I think the last thing is just to be organized. I'm so surprised by the amount of founders I meet, even if they're raising a pre-seed round or a seed round, where they don't have a clean data room, they don't simply have like their articles of incorporation. Like I think in a world now where capital is harder to come by, due diligence is a lot stricter than it was. It's actually really important to just be generally organized. And for me, it's much easier to do a deal with a founder who's got a great data room, even if it's just really early stage, like articles of incorporation, simple financial model, pitch deck, all in one place. If you don't have that, again, I think a lot of this is just about making it really easy for people to invest. And I think on the first point, one of the things I've seen in crypto, and I think it's paying, people are paying their dues from this now, but valuations typically are way too high, I think, in pre-seed and seed rounds. Founders want to have their companies out of the gates be worth 20, 30, 40, 50 million. I think those days are over in crypto. And most importantly, if you set your valuation too high out of the gates, I think where that's really going to impact you is trying to raise future capital, because I think the market where you're going to see the most contraction in terms of investment is actually at the later stages. These growth companies are way over invested in a lot of companies now. They're invested at much higher multiples, and that growth capital is going to be harder to come by. So I think if you set a really targeted early stage valuation with clear KPIs as to what you're going to do over the next 24 months, it'll be a lot easier to raise capital in the future than if you come out of the gates too high valuation-wise.
Yeah, go for it.
Yeah, maybe one thing that just came to my mind, it's about the MVP and the really product market fit. Is there really a problem, and do you really have a solution for it? Because especially what I experience super often at the beginning, like the founders are super hyped about their idea. They like it a lot. Their family, their friends, they support them a lot, and they think like this is going to be the next big thing. But then you really, really, really have to go out to the market and try to find out whether there is a need for your product and whether somebody wants to really invest in you or buy your product. Because if it's only friends and family, this is not like the real market out there. And we experience this very often, that people start building and then they have an MVP, but they still didn't talk to their customers, so they still do not know who are their customers and who is willing to pay and how much are the people willing to pay. So it's a huge difference whether you have a product where one customer is paying like 10,000 euros or you need like 10,000 euros and they're paying like €1. So this is something, and I think you also meant that with know your product, have everything together, be prepared for questions, and also know about your numbers to really be able to find out whether there's a need for that product.
Yeah, I just want to echo what both of you are saying on the simple stuff, which is knowing your product, knowing your numbers, kind of just having your shit together. I think it's actually quite surprising the founders that we talk to that maybe aren't as responsive to email when we're trying to ask for something, or when we ask for something like a deck or an executive summary, it's not really that polished, or when we dig into their data room, it's incomplete or has a lot of unfinished information in it. And those are things that I just want to make my job easy and my investment team's job easy. And if the founder makes that job easy, like, it actually means a lot to us to make the decision quicker. So all those smaller things, just being responsive, having clean, tight data rooms, even just being timely, and all of those are very, very important to us, or for me specifically. And I don't think that those are hard asks, but it does show a lot about the founder's work ethic and their just general style of working, which means a lot to us. And the second thing, I forgot what it was. I'll come back to it later.
I can help. So, because you said something, and I was at the first time when I realized about that, I thought that this is even not possible, about how to talk to potential investors. Because I saw that this is such a basic, easy thing, but I saw, because we help our startups sometimes with warm introduction, because this is one of the most important things, especially in the current time phase, that somebody is kind of doing some warm introduction and helping you to get even to talk to the investor. And then sometimes I saw emails like, "Hi, how are you? I'm fine. Do you have time to meet?" That's it. I was like, are you kidding? You can't send out those kind of emails. If there is somebody who should invest in you, you need to prove that you're worth to be invested in. Yeah, and make some suggestions. Send out the pitch deck, send out times, be more friendly, try to formulate a nice email. And the point is, you can do this once, and then you can do copy-paste, but this is not so difficult. But I've seen it several times, to be honest, and I was like, are you kidding?
I think people are laughing because they think that they never do this, but I do, I know being in that seat and being like, yeah, they say all this stuff, and that's never going to be me. But you never know. Maybe you call on a day where you're really busy and you want to be short with somebody. Don't do it. There are founders are busy. I get it, but take the extra attention, extra minute to have a coherent message, proofread your stuff, make sure your attachments are organized, and just simple things like that. They actually mean a lot.
Okay, I think you've discussed it a little bit, but what is the ideal model like? As a founder, how does one balance fundraising and building, hiring, all of the above? What does that look like to you guys?
So maybe just a quick thought on fundraising at the moment. It's basically a full-time job. I mean, we already said maybe at the moment it's not the best time to do fundraising, but if you really need to, it's a full-time job. And I've seen many startups struggling because they are only 2 or 3 people, because we are super early where we invest. And then there are 2 or 3 more people coming to the team, and then you have 5 or 6 people, and one of the founders is doing fundraising in the evening, basically. If everything else is done, he or she kind of starts sending out emails, asking, trying to get connections. It basically doesn't work. And it's something super simple again. You need to have a plan. Be totally clear on how many VCs or angels you want to reach. Send out those emails. Really track your KPIs. Did you send out 10 or 20 or 30 mails per week? I don't know. So really track your KPIs. See how many people are coming back to you, how many VCs want to talk to you, and then really ensure that there is, we already said, that there is enough time. For example, I also saw a startup, and they made a call, and that girl, it was a girl, she was on the street somewhere. This is so bad. You really need to be, you need to have a nice setup. And so fundraising is a full-time job at the moment. Don't underestimate it, and really make a plan 6 or 8 weeks. How many people? I mean, you can have a look at many kind of statistics, so you know about the churn rate, and so really try to figure out, to make a plan. Basically, that's it.
I think in general, it's an interesting question because fundraising has gotten a lot harder. I'm shocked by, there were deals in crypto that got done a year ago or pre-FTX that happened in 2 to 3 days, or I've even seen deals happen in 24 hours that were very hot deals. Now I'm meeting founders who are really talented people, great ideas, and their rounds are taking 8 weeks or longer. So I think when people think about what does it mean fundraising versus building, that's changed a lot in the last year. And I think for me, like an ideal team, if there was one, is usually a team that has a CEO who's very good client-facing, big-picture person, can raise the money, talk to investors, and has a team behind them that is either highly technical or product-driven, and so that these functions are kind of happening at the same time. I think a tragic consequence of a lot of companies is their CEO is the technical leader, the fundraiser, the product person, the salesperson, and now that fundraising is taking a lot longer and is significantly harder, that means they're not able to actually advance towards the goals. So I think in an ideal world, a team has a balance of somebody who could really be somebody who raises money and has people who could actually be building in parallel.
Yeah, I agree with that. I would say the CEO's role really changes with the kind of the runway of the company or the financial health of the company or even the market conditions, because the CEO's main job is to keep the lights on and to make sure there's enough healthy runway for the company. But at the same time, the CEO's job is to provide direction for the product and the project too. But knowing when to focus on what is the biggest key factor. And we do come across CEOs that have too much on their plate and it's hard for them to focus on all of it at once. So if there's founders and CEOs in the room, my biggest recommendation would be to kind of just like be all in on one or the other strategically, meaning, in a time like this, if you can afford to, please focus on building. And then when the fundraising market becomes more hot, then you can focus on raising. But focusing on both at the same time kind of just makes it so that you're not really in on the other one as much as you should be. And that's when it's important to delegate to your team and to put together a good team that you can trust to hold down the other side of the fort when you're focusing on one of the two things.
Maybe to add only one thought, because you said like focus, and I think this is something super important as well. Especially, I see it especially with super young founders. They are trying to cover everything, and at the end, nothing is really done. So really think what is strategically the most important thing that needs to be done, and then really focus on that. Because you can spend the whole time with answering any kind of emails, being on LinkedIn, Twitter, something like that, talking to many people, but really think about who are the right people to talk to and what is the right thing that needs to be done. Really, really think through that every single day. What is the most important thing to do today?
So as VCs, you guys provide a lot of support to your portfolio companies. I'm wondering if over the past, sort of year or so, there was a particular moment that stood out to you guys where one of your portfolio companies called you being like, we're really struggling, we need advice, we need help, given the market conditions?
Yeah, we had a few companies in our portfolio that were affected by Silicon Valley Bank, Signature Bank, FTX. So those were all situations where we had to get on the phone with them live as the situation was unfolding, as we were unsure ourselves what to do, and just kind of, we call it founder therapy. I think everybody kind of understands, as VCs and founders, that the relationship you have with the founders is not just like money in the bank. It's being kind of emotional support, business guidance, and all of those things, and being able to be there for the founders. So we were there for our founders during all of those events, and providing as much transparency and guidance that we can get from where we sit at Republic, and relaying that information to them, even if the answer is like, I don't know what's going to happen, but we will let you know as soon as we know. So I think just being that as transparent as possible to the founders, even in times of uncertainty, means a lot, and that's what we see our job as.
Joe?
Yeah, I think no differently than you. Every company that we were invested in during the crazy times, FTX, Luna, Silicon Valley Bank, all these things, was calling us. I think for us, like the biggest area where we're helping founders and where we add the most value is largely just by helping them advance their business. We have really deep connections in crypto. We built one of the biggest crypto companies before launching this fund. And for us, like in a world where all of a sudden people care about revenue and profits and growth, where maybe 2 years ago nobody cared if you were profitable or trending towards it, right now I think the most valuable thing we're doing for our founders and the way we're helping them is just getting them in front of the biggest potential clients, partners, et cetera, to actually help them get closer to those milestones in what is otherwise a tough environment.
Sarah?
Yeah, maybe. So for the startup that went through our incubator, we still have like contact points every single week because they are super early and we really support them at the beginning. So there was no certain point where they kind of called and said, okay, what to do? Because we have calls anyway every week. But of course, the topics changes, and sometimes it's more pressing and more difficult, and sometimes it's easier. But yeah, as everybody knows, 2022 was like not that easy.
Definitely tested the relationships between investors and founders.
I can imagine. So over the next year, what kind of trends do you guys see, or what have you seen in the last 3 months? I think last year there was a lot of investment into sort of exchange and trading related products, whereas this year maybe we're going to see more investments into infrastructure related protocols. What do you see? Any interesting trends coming up, or gaming? I know Joe, you have involvement with.
I think the most important trend for founders to really understand is that, in my opinion, crypto has moved out of the zone of absurdly high valuations, absurdly high multiples, and is moving closer and closer to what traditional markets look like. An interesting fact I share with every founder is, if you looked at the fastest growing 100 software companies in the world, publicly traded companies, growing 100+% year over year in revenue, worth more than 250 million market cap, they were trading at 18 to 30 times revenue less than 18 months ago. So if you were a founder doing $1 million in revenue or $2 million in revenue, as these growth investors start looking at you, applying those market metrics, you could say, okay, I got $2 million in revenue, companies are trading at 20 times sales, maybe I could raise my next round at 40 million. Those same 100 companies right now are trading at 4 to 6 times sales and revenue. So I think again, this comes back to my earlier point of the trend is you need to set your initial valuation much lower, because as you go out to raise capital from investors who are much more sensitive to your actual business fundamentals at later stage, the multiples that are going to be applied to your business are the multiples that are applied to real publicly traded companies. Those multiples are down 80% plus. And my prediction is that most people who raise money in 2021 and into the 2022 pre-FTX are going to either be doing down rounds, and in my opinion, the people who get hit hardest from down rounds are founders. Out of the gates, everyone wants a high valuation because it's sexy and they feel great. But the reality is, I know a company I talked to yesterday who did their pre-seed at $10 million. They did their Series A at 100 million post. They're at 150K in annual recurring revenue. They're out raising money right now, and they're getting term sheets for what their pre-seed valuation was. So I think this is a really important trend. You set your valuation wrong at the pre-seed stage, the person who's going to get hit hardest, or the people, I think, is actually the founding team.
Just a quick note on that. I think this is outside the scope of this conversation, but you're talking about equity right now. And when you talk about projects that have both token and equity component, that just blows everything out of the water. So when you're talking about token-oriented projects, that's just a completely different discussion that we don't have time to get into right now. But it's if you're a founder that's doing both, it's really important to think about value accrual to both of these things and how they play with each other.
Yeah, maybe to point out two areas. I think blockchain and AI is super obvious that this is going to be a super amazing trend, and I think there are many possibilities to combine those technologies, and I think this is going to be a huge trend within the next years. And something we see a lot, but maybe this is just my specific thing, is the refi space, so regenerative finance, because it all starts with the CO2 tokens, but there's so much more to come. And I think everything around ESG and the environment is going to be a super important big topic, and especially in that area, blockchain can help a lot with the topic, especially of transparency. So we like to focus on that area at the moment, and we think this is going to be important within the next years.
Sorry, I forgot to answer your question, which was on the topics. Definitely refi. I think having ESG-friendly initiatives and allowing ESG-friendly initiatives to thrive using Web3 technology is very, very important. And another thing that I don't think is a trend yet, but I'd like to see be a trend, is Web3 apps that have more of a friendly UI, user onboarding experience. So currently, I think the problem still is that everyday people have trouble accessing the technology, and we don't do enough to make it easy to onboard users. I think people are exploring it, but it is something that I'd like to see more of and would definitely deploy capital into those types of projects.
Can you give, I don't know if everyone's familiar with the refi space within crypto. Can you give an example of like a cool company that's related to refi?
I could start with one that I guess I could show on stage, but I'm an investor in a company personally and on the board of a company called Codex Energy. It's based in Texas, and it's not necessarily a play on tokenizing carbon credits or anything like that. What we actually do is we buy the natural gas that oil and gas companies are just venting. So a lot of these oil producers actually take the excess natural gas they produce and they just burn it into the environment. People who have oil wells that are no longer producing oil also but are producing gas are just burning it into the air. And so we're actually able to go to these sites, capture all of that gas that would otherwise be flared, put it through generators, and actually power these off-grid Bitcoin mining operations. We've got 4 major oil companies we're doing this already with, and it's actually, for me, very exciting because a lot of these ESG plays, at least from the ones I've looked at, are very infrequently profitable, especially without subsidies. This was a very unique angle on both being climate friendly, driving off-grid Bitcoin mining, and solving a real problem.
Cool, thank you. Bryan?
Yeah, that one's really cool. And there's one that we've worked with called Regen Network, which not only tokenizes carbon credits, but tokenizes carbon credits that they know come from regenerative farming techniques. So they work directly with farmers in Australia and Latin America that help kind of bring carbon back into the soil and tokenize that carbon.
Nice, thanks guys. That's all we have time for, but I believe we can take questions from the crowd if anyone has anything they want to ask. Oh no. Oh no.
We're not allowed to take any questions.
Can we just take one? Just one. This guy's ready.
Hi, thank you very much. I was just curious, what's the best sign that a company or a project should kind of raise? What are the conditions of a pre-existing project that's kind of operational? What do you guys look for that are some good signs that it's kind of the right time?
That depends on the stage you're trying to raise at, though.
Mm-hmm.
Can you clarify a little bit more?
Oh, just like where something's completely operational, like we've got a product, an MVP, it's there. I mean, there's the constant development, but it's like, okay, new product, but it's a small team or something, and you're kind of always developing.
I think it just comes down to runway. I mean, I think, again, people a year ago were much less reliant on their runway because they thought they can keep raising more and more capital at higher and higher valuations. I think for us, like, we're just looking at like how much runway do people have? What are the KPIs they're building for? Like, why do you actually need capital? What are you going to do with it? So I think it's runway, and I think now people need more runway than they ever did because it's going to be a lot harder.
I'll add really quickly to that. On top of runway, I care a lot about use of funds. So like how much you're raising and why you're raising that amount. And if you could justify that, then that's really helpful to me.
And very obvious, your team. So which kind of track record do you have? Like, I mean, especially at the beginning, it's super important.
Awesome. Thank you.
Thanks guys. Thank you very much to my panel.